What is the stock market? The stock market is a collection of exchanges where publicly traded companies list their shares for buying and selling. It functions as a marketplace, connecting buyers and sellers of ownership stakes in businesses. Major stock exchanges include the New York Stock Exchange and NASDAQ in the US, as well as international exchanges like the London Stock Exchange and Tokyo Stock Exchange. The stock market serves as a crucial component of the global economy by facilitating capital formation, providing investment opportunities, and serving as an indicator of economic growth. Stock markets show activity over time, with prices reflecting the collective decisions of all market participants. The stock market operates in two main segments, primary and secondary markets. In the primary market, companies issue new stocks through initial public offerings, or IPOs. This allows companies to raise capital directly from investors. Once issued, these stocks trade on the secondary market, the exchanges where most daily trading occurs. The secondary market is where investors buy and sell existing shares among themselves, with no direct involvement from the issuing companies. Most stock market activity that we hear about in daily news refers to secondary market trading. After a company goes public through an IPO in the primary market, its shares begin trading on the secondary market, where prices fluctuate based on supply and demand. The primary and secondary markets are interconnected. Companies first raise capital through IPOs in the primary market, after which their shares begin trading between investors in the secondary market. It's important to note that while companies only receive capital from the primary market, the secondary market provides essential liquidity and price discovery for investors. The stock market functions through the interaction of various participants, each with their own roles and objectives. These participants form an interconnected ecosystem, all centered around the market itself. Retail investors are individual traders who buy and sell stocks for their personal portfolios. Their market presence has grown significantly with the rise of online trading platforms and apps. Institutional investors, like pension funds and mutual funds, manage large portfolios for groups of people. They have significant market influence and often set market trends through their trading decisions. Market makers are crucial for providing liquidity. They stand ready to buy or sell specific stocks at publicly quoted prices, which helps reduce price volatility and ensures markets function smoothly. Brokers facilitate trades between buyers and sellers. They provide the platforms and services that allow other participants to execute their trades, often charging commissions or fees for these services. Regulators like the Securities and Exchange Commission oversee market operations to ensure fairness and transparency. They create and enforce rules to protect investors and maintain market integrity. These participants don't operate in isolation. They form a complex, interconnected ecosystem where each plays a crucial role in maintaining market functionality and integrity. Understanding these market participants and their relationships is essential for anyone looking to participate in the stock market effectively. Market indices are essential tools for understanding and tracking stock market performance. Stock market indices track the performance of specific groups of stocks, providing a snapshot of overall market performance. Let's explore the major U.S. market indices that investors commonly reference. The S&P 500 tracks 500 large U.S. companies and covers approximately 80% of available market capitalization. It's weighted by market capitalization, giving larger companies more influence on the index. The Dow Jones Industrial Average follows 30 significant U.S. stocks and is calculated as a price-weighted average. It's the oldest continuing U.S. market index, dating back to 1896. The NASDAQ Composite focuses primarily on technology companies, with over 3,000 companies listed. Like the S&P 500, it's weighted by market capitalization. Market indices exist in financial markets around the world. Some prominent global indices include the FTSE 100 in the UK, the Nikkei 225 in Japan, Germany's DAX, and the Shanghai Composite in China. The FTSE 100 represents the top 100 companies by market capitalization on the London Stock Exchange, while the Nikkei 225 consists of 225 large companies traded on the Tokyo Stock Exchange. Market indices serve as essential benchmarks for investors and financial professionals. Indices provide a reference point against which investment performance can be measured. Here, we can see how a managed fund performs compared to a market index over time. Indices serve three primary purposes. They help gauge overall market trends and economic health, provide a standard for comparing investment performance, and assist in developing and testing investment strategies. Index tracking funds have transformed how investors access the market. Index funds are investment vehicles that aim to replicate the performance of a specific market index by holding the same securities in the same proportions. Index funds offer several advantages. They provide a low-cost way to diversify across an entire market, typically charge lower management fees than actively managed funds, maintain transparent holdings that follow a specific index, and are available in various formats, including mutual funds and exchange-traded funds. To summarize what we've learned, market indices track specific groups of stocks to provide snapshots of market performance. Major indices include the S&P 500, Dow Jones Industrial Average, Nasdaq Composite, FTSE 100, and Nikkei 225. These indices serve as important benchmarks for performance comparison. And index funds offer investors an easy way to invest in entire markets rather than selecting individual stocks. Technology has fundamentally transformed how stock markets operate. The evolution of trading has moved from physical trading floors to sophisticated electronic systems over the past several decades. One of the most dramatic changes has been in trading execution speed, which has accelerated from minutes to microseconds. Mobile applications have democratized investing, allowing anyone to trade stocks from their phones with minimal fees. Real-time data and analysis tools now give investors immediate access to information that was once available only to professionals. These technological advances have increased market efficiency while creating new challenges for regulators to monitor and control. As technology continues to evolve, markets will become even more efficient, but the balance between innovation and regulation remains a critical challenge.